You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 28th of October 2025, and I'm joined today by my co-host John McEwen. In this week's episode, we'll be discussing Supreme, Unilever, B&M, Reckitt Benckiser, Coca-Cola Hellenic Bottling Company, and Coca-Cola. John, should I start us off with, it might be in the fantasy portfolio actually, but it's definitely in my portfolio anyway, and one that we have covered a lot, Supreme.
So yeah, and is it AIM listed? It's certainly the smallest company of the week.
Yes, it is. It's AIM listed, this one. I'll not explain what they do because we have covered them quite a lot in the last few years, but they have announced the acquisition of SlimFast UK and Europe. Yes, I'll just read straight from the RNS, which detailed the acquisition. So they've said, Supreme, a leading manufacturer, supplier and brand owner of fast-moving consumer goods, is pleased to announce the acquisition of the trade and selected UK and European assets of SlimFast, a market leader in meal replacement products, for a total cash consideration of $20.1 million, including $9 million of deferred consideration during 15 months' time, from Glanbia plc, a global nutrition and food company. The group will satisfy the consideration through a mixture of its existing cash resources and utilisation of its assets-based lending facility. Founded in 1977 in the US, SlimFast is a heritage weight management brand known for its meal replacement shakes, bars, snacks, and weight loss plans. SlimFast has a strong position in formats including ready-to-drink and ready-to-mix powder products, as well as advanced nutrition range, which includes high-protein, high-fibre, gluten-free meal replacement shakes and smoothies. SlimFast's UK and European established sales footprint comprises Amazon, Home Bargains, B&M, Asda, Sainsbury's, Tesco and Morrisons, existing customers to Supreme, and will provide Supreme access to Boots and Superdrug. For the year ended 31 December 24, SlimFast's UK and European assets reported unaudited revenue of $25.5 million and adjusted gross profit of $9.7 million. In the strategic rationale, they've said, the acquisition is fully aligned with Supreme's ongoing M&A strategy, adding highly recognisable brands into its diverse portfolio of high-frequency consumable products. The acquisition will be immediately earnings-enhancing. SlimFast is highly complementary to Supreme's existing drinks and wellness category, further expanding the group's presence in the weight management market, a market that is projected to reach $1.5 billion by 2027. Supreme believes that SlimFast is ideally placed to capitalise on the growing demand for GLP-1 products, which will require nutrition and protein supplementation both during treatment and as an ideal follow-on. Supreme anticipates unlocking meaningful synergies by integrating SlimFast into its well-established, fully vertically integrated distribution platform. Supreme already services a number of key SlimFast customers, with additional upsell opportunities already targeted across the 55,000 retail sites that Supreme currently supplies, including leading retail chains, cash and carry, business-to-consumer e-commerce, and the convenience channel/independents, which do not currently stock SlimFast products. The acquisition further enhances Supreme's retail network, particularly within the UK, through the addition of new retail customers such as Boots and Superdrug, providing further cross-selling opportunities for the group. The acquisition also provides Supreme the opportunity to expand SlimFast globally, excluding the Americas, Australia, the Caribbean, and the Philippines. Supreme plans to move to manufacture all the powder products, 40% of turnover in-house, thus providing considerable scale to its manufacturing operations, benefiting its entire drinks and wellness division. In terms of the valuation, Supreme trades at a PE of 8 and has a yield of 3%. It's worth noting, so the Supreme gross profit currently is $33 million in the 2024 results. SlimFast alone had a gross profit of $9.7 million, so this would increase it by about 30%. I think this is a very good acquisition. I like it for a number of reasons. I like it firstly because it helps move away from vaping and other kind of nicotine-related products, which, although they've done incredibly well for the group, they are a very large proportion of revenue. I think it fits in very nicely with some of the other acquisitions they've made. So, for example, the Thai food tea that they bought, I think it was earlier this year, they've obviously got the Sea Lions brand with vitamins and minerals, so that would fit in quite well. But as well, they've just proven themselves to be a very, very efficient operator. So if they're moving the manufacturing in-house to the Manchester sites, that gross profit, I think, will be translated to a much higher operating profit than SlimFast was producing on its own based on previous acquisitions. So I really like it. Very happy with this as a shareholder. John, what do you think?
I think it's very good. I think it makes a lot of sense, and I think it is a strong brand. Yes, there's all the noise about GLP-1s, but then it's not just that. You've got to have diet, you've got to have everything else that goes with it. And I think it makes sense if you look at the other brands that they have. They've got quite a lot of vitamins and minerals that they sell in their sort of health and wellness division. So it fits in nicely with that. And I think it's also interesting that they're going to be supplying Boots and Superdrug through this channel. And you do wonder whether that it'll open up to more of the Supreme brands, and that could really, unlock things further for Supreme. Again, as you mentioned, it's a diversification away from vaping, which, given how concentrated it has been historically, is probably not a bad thing. I'd be interested to see how Typhoo plays out for them, because that was something that had struggled previously under private equity. But I think if you look at the portfolio overall, lots of strong brands, and then they've got things sold every day. You've got Duracell batteries, Energizer batteries, and Energizer. So I think it actually at 8 times, is it 8 times forward earnings?
Just 8 times earnings.
8 times earnings. It's not expensive. I suppose one of the things that is factored into that is that it's obviously a small company. It's controlled by the founding family, whether you see that as a positive or a negative. And if there were any legislative changes when it comes to the vaping market, it is UK focused, and that would be a big hit to Supreme. I appreciate, you may say, well, I can't see that happening, but if it were to happen, then that would, significantly impact Supreme. So there could be a fair bit of volatility there. I guess at 8 times earnings, a lot of people would probably be willing to take that risk, though. And given the growth it has been delivering, again, I'm sure a lot of people would be prepared to pay up for that.
Should we move on to a favourite of the show, Unilever?
Yes, absolutely. The biggest UK listed consumer goods company of the week, with a market cap of about 113 billion. It doesn't really need very much introduction. We've covered it lots of times before, but it has massive brands: Dove, Ben & Jerry's, Lynx. You can go down the list. Most of what I say most, half of what you see in the supermarket is possibly a Unilever product. Billions of people worldwide use their products every day. Anyway, they had their third quarter revenue out last week with revenue of 14.7 billion euros, reflecting underlying sales growth of 3.9%, 4% excluding ice cream, slightly ahead of the market forecasts. Growth was driven by its power brands and improved performance in the emerging markets, with all business units contributing positively. The group expects to deliver cost savings of around 650 million euros of its 800 million euro cost saving program in 2025, the remainder to be completed in 2026. As previously announced, the demerger of its ice cream business has been delayed by the US government shutdown, but it's expected to be completed by the end of the year. Full year guidance has been maintained, with underlying sales growth expected to land in the between 3 and 5% range, and a quarterly dividend of 45 cents a share was announced, which is up 3%, and the shares were broadly flat in early trading. In terms of valuation, Unilever has a market cap of £113 billion and trades at 17.3 times forward earnings, compared with a 10-year average of 18.9, and it currently yields 3.5%. I thought these results were all right. I think you can't get too excited about 3.9%, but given that there have been a number of difficult years, they're pumping more revenue than they have in the past 10 years into marketing and reinvesting in those core brands. I think, alongside the cost saving, I think it is going to pay dividends, but probably in the next year or two. We haven't seen a huge amount happen with the share price, and we've really been waiting, ever since starting the show about 5 years ago, for it to really take off. I know we'd been to see Terry Smith back at the last Fundsmith AGM, and he'd certainly been very positive about the new CEO that not that many people were familiar with, Fernando Fernandez, who had been the CFO previously. So I remain optimistic with Unilever. It's been in my portfolio for over a decade. I think it was certainly back in the Philip Pullman days when I really saw the growth and certainly the returns in the share price. It has been stagnant. I think it is going to get back to that, but we're still slowly getting there, I would say. Ice cream business being spun off, we've discussed this in the past. I don't think either of us were particularly keen, but equally, you can hold it as a separate company when it is spun out. And it'll be interesting to see how much debt they load onto it too. And as mentioned in the statement, it's been delayed by the government shutdown in the States. So we will see what happens. I'm quite happy holding it. Interesting when it comes to the multiple, that certainly has crept up in the last year or two, I think, in anticipation of the growth coming back. But let's see. Sam, what are your thoughts on this Q3 statement from Unilever?
Pretty similar. There's not much exciting in there. I suppose it still needs a bit of time for those cost savings to start flowing through properly. And I think the new CEO still needs a bit of time because he's not had loads and loads of time. I mean, what's he had, like 10 months or something like that, 8 months. So I think it's more of a wait and see. It's not terrible, but I think he needs another sort of 6-12 months before we can make any kind of judgments, really.
Yeah, no, absolutely. Okay, then on to B&M.
Yes, so it's a business we covered very recently because they issued a profit warning. And here we are just a few weeks later because they have issued another one. B&M have, last week updated their announcement of 7 October, which we covered, regarding the outlook for the current year. And they've said the group's financial half-year-end results consolidation process has identified after the announcement of 7 October approximately 7 million of overseas freight costs not currently recognised in cost of goods sold, following an operating system update earlier this year. The underlying system issue has been resolved, but its financial impact is material to the outlook. Therefore, they have reduced the outlook based on revised second quarter margin run rates, and group adjusted EBITDA is now expected to be in the range of 470 to 520 million compared to the previous estimate of 510 to 560, so a very big reduction. And for the half, they now expect to report adjusted EBITDA of approximately 191 million compared to previous guidance of 198 million. As previously disclosed, UK like-for-like sales are expected to be the principal driver of the outcome within this range, for which they reaffirm their assumption of a second half UK like-for-like percentage growth rate of between low single-digit negative and low single-digit positive. They continue to expect that like-for-like growth, future adjusted EBITDA margins for B&M UK can stabilise at low double-digit percentage levels over the medium term. The board intends to commission a comprehensive third-party review of this matter, and Mike Schmidt, the CFO, has advised the board of his intention to step down from the board and his role as CFO. A search for his successor has commenced, but he'll remain in place until a replacement is found to ensure an orderly transition. A further update will be provided alongside the interim results, which are scheduled for 13 November 2025. In terms of the valuation, firstly, the shares didn't react very well to this, as you can imagine. They were down 17% on the day, and they're now down about 30% for the month, and that's on top of what was already a very bad year for them. So 52-week high, £4.09, currently sitting at 185p. They've actually bounced a bit off the 52-week low of £1.62. In terms of valuation, they're now trading at a P of 5.73 and have a dividend yield of 8.1%. But based on these issues, I think it's pretty likely the dividend gets cut. Obviously, this is very disappointing. I think B&M, it's a company that I've liked. I would have put it as one of the higher quality retailers on the FTSE, actually. I'd have probably put it definitely top 10, possibly even top 5. I think he's been a very good operator, and I think this is really, really disappointing to see. I just think really because I think the fact that the CFO's staying whilst they help find a successor suggests there's not really any evidence this was deliberate. So you've got probably the best case scenario is that it's just pure incompetence. But I think once you get to a point where you can't trust the figures, it doesn't really matter how cheap it gets. And for me, that is a shame because although as we've discussed at length on the show, very reluctant to buy another retailer, it is one at the right price I would have considered. And I just, because of that quality, and I just think for it to now be in a position maybe where Tesco's was sort of 10 or 15 years ago, where you just can't trust the figures. There probably is a turnaround there. if it does turn out that this mistake is a one-off and they go back to sort of how they were doing a few years ago, I think you could do very, very well. But it does just remind me of the Buffett quote that it's rare there's one cockroach in the kitchen, and there might be nothing more that comes out, but I just wouldn't want to take the risk. And for me, it was a shame because it was business that I consider to be very high quality. What about you, John?
It comes into the uninvestable at the moment for that same reason. So it is disappointing on many fronts, but I wouldn't go in until things have really been sorted out and it becomes clear either it's isolated or, as you say, there are more cockroaches in the kitchen. So let's see.
You've learned your lesson about investing in retailers after accounting scandals.
Well, I had with Tesco. It was just the horse meat scandal. I invested after that. The accounting one came later. So the horse meat. Well, we won't go into that. But
It's
anyway.
a good example of one cockroach in the kitchen, I guess.
Yeah,
Isn't it?
yeah, that's right. It was just horse in the kitchen.
Well, followed by an accounting scandal. But yeah, should we move
that's
back
right.
to consumer goods then?
Yeah, no, absolutely. So Reckitt is not a favourite of the show. It's one that I used to own and is one of the two big ones in the UK, second only to Unilever. They own a lot of big brands, Durex, Finish, and then also quite a lot of the cleaning brands like Dettol. Anyway, they had their Q3 trading statement out last week with third quarter net revenue of £3.6 billion, reflecting like-for-like sales growth of 7% against the 6.4% expected. Its core operations drove the results, helped by strong double-digit growth in emerging markets and a return to growth in North America and Europe. Performance in its non-core operations was mixed, with strong growth in Mead Johnson Nutrition, more than offsetting a decline in the Essential Homes business. Full-year guidance has been maintained, with like-for-like net revenue growth of more than 4% expected in its core business. A quarter of the ongoing £1 billion share buyback has now been completed, and the shares were broadly flat in early trading. In terms of valuation, Reckitt has a market cap of €39.7 billion and trades 16 times forward earnings, compared with a 10-year average of 18.7, and it has a prospective yield of 1.7%. I thought these results were good. I think the turnaround is certainly beginning to take more shape. I think it's a business that, when we've covered it over the last 5 years, and certainly even if you look back probably over the last 10 years, it's really struggled. It's been very bloated. It's gone through a few CEOs. It's made unwise and really huge acquisitions when it purchased the formula division. And now it didn't perform as it was expected to. There were sort of factors way beyond its control, but it paid a lot for that. And particularly when you saw the slowing birth rates in China, that materially impacted on the sales growth for something that it probably, well, almost certainly overpaid for nearly 10 years ago. I think they are rebooting the portfolio and they're selling off some of the lesser brands. I would question, though, whilst it's got some decent brands in there, I don't think it's got the scale and the quality of the Unilever brands. And yes, these results are better than the comparative Unilever figures. I think when you compare them, even when Unilever's been underperforming in the last, broadly speaking, 10 years, still Unilever has outperformed Reckitt over that time. If it were between the two, I would be sticking with Unilever. I did sell my Reckitt shares about a year or 18 months ago. I'd held them for a long time and didn't really see any comprehensive plan to reboot the business. It's encouraging that things are picking up now, but I think in the consumer goods division, you can probably do better. I think if I were looking for maybe a slightly more deeper value, there's Kraft Heinz over in the States. I think when you go into the higher quality, there's Unilever and there's also Nestle, which has fallen from grace a little bit in the last year. So I think there are better ones out there, and I wouldn't really go to Reckitt over those ones. The other one to mention too is Haleon, which is now beginning to get to fairly decent sustained growth and paying down its debt after that was spat out by Glaxo. So again, I think there are better ones available and potentially some more attractive valuations elsewhere in the market. Sam, what are your thoughts on this Q3 statement from Reckitt?
I agree. I think it is a good statement. I think it's the best set of results we've seen from them probably since lockdown ended. But I think there's an element maybe of low-hanging fruit there in that they've done really poorly for a few years now. It's good to see the turnaround happening, but I just think, well, can they go and sustain that for sort of 2, 3, 4, 5 years? And I'm not sure based on what we've seen previously. And I just think if you're going to go and pay a forward PE for that performance, like you say, why wouldn't you just pay, if you're paying 16 times earnings, why wouldn't you just pay 17 for Unilever, get the higher quality business? And I agree, Haleon, since that's been spun out, I actually think I'd probably rather own Haleon than Reckitt. I think operationally, I think it's just done a better job than Reckitt has in the time we've covered it. Kraft Heinz, I think it's been a couple of years since we covered that one. I was splitting out anyway, so there's Kraft or Heinz to choose from. But like I say, there's just no shortage of quality consumer goods companies. Good set of results, but for me, I just think there's better options out there as well.
And for reference, if we do go to Nestle, because we had certainly been covering that a lot at one point. I think it's almost since it's dropped off, we've covered it a bit less, but that's trading at 19.1 times forward earnings.
Yeah, so again, I'd rather pay the extra 3 for Nestle.
Yeah, and it's got a better dividend as well of about 3.6%.
Should we move on to Coca-Cola HBC then?
Yes, so another one of your stocks, Sam. Oh, no, in fact, it isn't, is it? Sorry.
Unfortunately, it is not. I really, really wish it was. It's one of the stocks highest up my watch list, but unfortunately, you don't make money from that. So, so Coca-Cola Hellenic Bottling Company, a company that we have covered for a while now, both grown increasingly fond of as we've gotten to understand it better. They have come out with a trading statement and also an acquisition update. So I'll start with the trading statement. Third quarter highlights include organic revenue growth of 5%, which brings the year-to-date organic revenue growth to a strong 8.1%. And that organic revenue growth was across all 3 segments, despite a mixed market environment and less favourable weather. So in established markets, organic revenue growth was 1.2%, developing markets 4.8%, and emerging 7.9%. With revenue per case expansion and volume growth of 2%, led by strength in Nigeria and Egypt. So I probably should have said earlier on, but Coca-Cola Hellenic Bottling Company, it's one of the Coca-Cola bottlers, and it operates, it does the bottling and distribution and basically just kind of licenses Coke in the countries it operates from Daddy Coke, which we'll be covering next. But it operates predominantly in a lot of emerging markets. It has historically mainly been Eastern Europe, or Eastern and Central Europe. It has acquired a few more recently. So it recently acquired Egypt in the last couple of years, for example. Back to the trading statement. So they launched a new monster drink with Lando Norris in 16 markets. They've highlighted strong growth of coffee in the out-of-home channel, driven by both Costa Coffee and Cafe Vignano, as we executed our strategic decision to focus on this channel. And on the same day the trading statement came out, they also announced the agreement to acquire Coca-Cola Beverages Africa from the Coca-Cola Company, so Daddy Coke, as we refer to it, and Gutcher Family Investments. There is a separate press release on that, which I will now move to. So the Coca-Cola Company and Gutcher Family Investments have agreed to sell a 75% controlling interest in Coca-Cola Beverages Africa to Coca-Cola Hellenic Bottling Company. Coca-Cola Beverages Africa is the largest Coca-Cola bottler in Africa. It operates in 14 countries on the continent and accounts for about 40% of all Coca-Cola product volume sold across Africa. Coca-Cola HBC is one of the largest Coca-Cola bottlers in the world and operates in 29 countries across Europe and Africa, including Nigeria and Egypt. Coca-Cola will sell 41.52% out of its 66.52% stake in CCBA, Coca-Cola Bottling Africa, to Coca-Cola HBC. And Coca-Cola HBC is acquiring 33.48% from GFI, which is Gutcher Family Investments that I mentioned earlier. In total, the transaction value is 100% of Coca-Cola Bottling Africa at an equity value of $3.4 billion. The transactions are targeted to close at the end of 2026, and Coca-Cola and Coca-Cola HBC have also agreed to a separate option agreement for Coca-Cola HBC to acquire the remaining 25% of Coca-Cola Africa, which is still owned by Coca-Cola, within a 6-year period from closing. There's a lot of Coca-Colas to follow here, so I do apologise. But the sale of Coca-Cola's stake in Coca-Cola Africa is another significant step in the ongoing refranchising of company-owned or controlled bottling operations. So it looks like this is part of a wider plan from Coca-Cola to sort of get rid of the bottlers that they're dealing with in-house still or own in-house, just to license them out to businesses like Coca-Cola HBC. And they said following the closing of the acquisition, Coca-Cola HBC will represent 2/3 of Africa's total Coca-Cola systems volume and cover over 50% of the continent's population, solidifying its long-term commitment to growth in Africa. As part of the acquisition, Coca-Cola HBC will pursue a secondary listing on the Johannesburg Stock Exchange, underpinning its commitment to South Africa and the African continent. And for reference, but Coca-Cola Africa operates in 14 countries, and they include South Africa, Kenya, Ethiopia, Uganda, Mozambique, Namibia, Tanzania, Botswana, Zambia, Eswatini, Lesotho, Malawi, and the islands of Comoros and Mayotte. In terms of valuation, Coca-Cola HBC currently trades at a PE ratio of 17.6 and has a dividend yield of 2.54%. I love this deal. I think it's a really, really good deal. I think we've already talked about previously when we've covered it how attractive Coca-Cola is in that it gives you a play on emerging markets, but with the safety of the Coca-Cola brand. And I think to be able to give you more of a play on Africa, which is something that's quite difficult to get almost a pure play exposure to. I appreciate this isn't pure play because they've got all the Europe stuff as well. But to add that into those emerging markets, I just think it makes Coca-Cola Hellenic a really, really attractive investment, not just because of the quality of the business, but just because it can sit in a space in your portfolio where it's actually very, very difficult to add something in there that you understand and can visualize in what I consider to be quite a low risk way. I just wish I'd bought it when I think we started covering it around the time that Russia invaded Ukraine. And
Yeah.
it was really, really cheap then. So just for context, it's currently trading at £35 a share nearly. That is down from a 52-week high of £41. But if you'd bought it immediately after Russia invaded Ukraine, you could have got it for about £17 a share, something like that, 16, 17. So, yeah. Anyway, it is what it is, but really high quality business, really high up my watch list. I'd love to see a bit of a pullback on this because it's a business I'd really, really like to add to my portfolio. I do question at what point you just consider just paying up for it and accepting it's a quality business, because I think the PE 17.6, it's not outrageous considering the performance this business keeps putting up. What do you think, John?
Yeah, no, I mean, obviously it's all on this acquisition in terms of the big news in the last week or two. I like it a lot. I think we actually did start covering it before Russia invaded Ukraine. And when we were covering it then, I think we thought it looked interesting, and it was still that sort of emerging markets play on the Coca-Cola brand. And then obviously they had a sharp share price drop when that happened. And I remember thinking about it at the time, it's almost like, I'm glad I didn't invest in it at that point. And okay, maybe it wasn't the most expensive stock on the FTSE, but that was the sort of risk that it came with that emerging markets play. I think the more that we covered it, though, and we saw how it was actually quite a bit more diversified than perhaps the market thought immediately after the invasion, and seeing how it's performed since despite that. And now with this really smart acquisition of the Coca-Cola Bottling Africa, it does look like it's a very exciting play going forward on the Coca-Cola brand in even wider emerging markets. So, yeah, would I pay up for it? Possibly. I think with that acquisition, it's gone higher up on the watch list, certainly.
Same price as Unilever as well.
Oh, well, I know.
I
know. So that probably is telling me something.
It's hard. I'd just really like to see a pullback in it. That's the only thing stopping me buying it now is valuation.
Yeah, but you have been saying that for a while
3 years.
now. And I suppose you could say it's had a little bit of a pullback, maybe 10% or so. Okay, On to what you referred to as Daddy Coke. So listed in the US, the parent company, which has a market cap of $301 billion, so absolutely massive. They had their third quarter results out last week, with revenue rising by 6% organically to $12.5 billion, which was in line with market forecasts. Growth was driven largely by higher average selling prices, whilst increased volumes contributed 1 percentage point to the uplift, and it was helped by strong growth in Coke Zero. Underlying operating profits grew by 15% to $4 billion, ignoring exchange rate impacts, slightly ahead of market forecasts. And this was largely driven by a tight grip on the sales and admin costs. Free cash flow rose from $1.6 billion to $2.4 billion due to the uplift in profits, and net debt was $33.5 billion at the quarter end. Full year guidance has been reiterated, with net revenue expected to grow organically by 5 to 6%. Since the period end, the group has agreed to sell around 42% of its 67% stake in Coca-Cola Beverages Africa, as Sam mentioned, the largest Coca-Cola bottler in Africa, for around $1.4 billion. And the deal is, as mentioned, expected to complete by the end of 2026. And shares were up nearly 3% in pre-market trading. In terms of valuation, the group has a market cap, as mentioned, of $301 billion and trades at 21.6 times forward earnings, compared with the 10-year average of 22.7, and the shares currently yield 3.1%. I mean, I thought these results were fantastic. Revenue up by 6%, and despite what you think about how saturated Coca-Cola is, to grow volumes by 1% as well, and particularly on Coke Zero, is impressive. Yes, it's certainly not cheap, but you're never going to get the probably most famous brand in the world cheaply. It does raise the question, when we've got Coca-Cola HBC on this week, in terms of which you would rather go for. I think there's a lot of me that would probably say I'd rather go for Coca-Cola HBC and potentially see what the emerging markets can continue to deliver where Coca-Cola is not saturated. And I think Coca-Cola HBC is the company to do that with. It's cheaper than Daddy Coke. Of course, there is much more risk with it, but that's probably what I would be more inclined to do. And as I say, it's very high up on my watch list now. Sam, what are your thoughts on these results from Coca-Cola?
Yeah, really good set of results. Quite a bit above inflation, which I think anything above inflation really for a business of Coca-Cola's size and saturation is a win. So yeah, 6% organic growth. I don't think you can ask for more than that. P of 21, I would agree with you. I'd rather have Coca-Cola Hellenic for 17. I appreciate it's maybe higher because you are getting a higher quality business with Daddy Coke, but it's just so saturated. But yeah, can't knock these results at all. We have seen it more expensive compared to historically. So of the 6 businesses that we've covered this week, then Supreme, Unilever, B&M, Reckitt Benckiser, Coca-Cola HBC and Coca-Cola, which do you like the most and which do you like the least?
I think it's quite an easy one this week. I would go for Coca-Cola HBC, and last I would go for B&M, but that's kind of by default.
I would probably put Supreme number 1, just mainly on valuation. That P of 8, I think still is what the reason it's in the portfolio, and Coca-Cola HBC isn't for me. But if it was just a slightly lower, I think it would be Coca-Cola Hellenic. Bottom, same, B&M. It's just become uninvestable, unfortunately.
Well, on that bombshell, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.